this is one of the most exciting categories that we're going to discuss now. And we have three panelists who are like the prominent fund managers in this asset class. I would like, each one of you to introduce and just yourself and give us some inputs about your experience with Cat3 and something that you can share about your fund or your strategy, how you go about it.
Sure. Thanks, Vinayak. So basically, I'm part of Ambit Investment Advisors, managing Ambit Alpha Fund. It's a absolute return, objective, long-short equity fund. This is the strategy we've been running for now about last 9 years, right from Merrill days, and we've found this strategy work in each of the market conditions. So have been doing this for long now, and we think that's a great opportunity in India on the whole alternate space, and we're pretty bullish on the whole alternate space.
Terrific. So I'm one of the founders and the principal fund manager for Forefront Capital. We manage about 1,000 crores of assets today for about 500 of India's top families and institutions. And we were the first people to be awarded the Category 3 license. And I think it's been an amazing journey to not only build a company, but also to be a pioneer in this industry. I'm personally very, very excited about Category 3 AIFs, and I think that we have just scratched the surface in terms of the opportunity. In terms of what we do, we have an absolute return approach to investing in equities. We do a lot of corporate action and other kinds of arbitrage, and then we also do a selective amount of hedging in our portfolios.
Thank you. Harmony Capital is an investment manager for Harmony Hedge Fund. Harmony Hedge Fund is a scheme of Harmony Alternative Investment Fund Trust, and we are there since Jan 2013. We are also an absolute return fund. We run long-short directional strategies across asset classes. Of course, there is no enough asset class at the moment in the AIF space, but for currency and equity. And we have got we basically concentrate on the reward to risk ratio that is very critical for any wealth manager to take a call on validating or evaluating a hedge fund. So instead of focusing just on the return side, we are also trying to provide data in terms of what is the kind of risk the fund has undergone in its historical period, and what is the return in the process it has generated. And return as a combination of risk will give a very great perspective to the managers, wealth managers or investors to take a call on investments. In terms of strategies that we use, the strategies are very objective in the sense that there's no, the level of subjectivity is very, very minimal, and most of our trading strategies are back tested. And the biggest advantage is we have the discipline and the conviction to follow our strategies. At the same time, research is not a crisis management approach here. Research is an ongoing exercise. So it's a development-oriented approach. So even though we are very, very objective and very disciplined at the execution desk, we are very, very creative at the research desk. This is about us.
Great. So, that's the brief introduction that we got from all the fund managers and about their respective strategies. And since we are discussing Cat3 funds, which in my opinion is like, India's equivalent of hedge fund, a very exciting asset class. So, I would just want one of you or all of you to share, like, how has the experience been in terms of running the fund as well as positioning the fund? Because it's only started about 3 years back, the regulations came in. So positioning as well as the experience when you started off.
Sure. So the positioning of the fund actually would depend on the strategy you would adopt in managing the fund. So for us, it's an absolute return fund and a long-short equity fund. The first, while we communicate with the clients, the first hindrance or the first roadblock is basically how are we able to make a client understand or investor understand what is absolute return fund. And this is something which is not benchmarked to your traditional source, like traditional benchmarks like Nifty or Sensex. So that's one of the trickiest part, making them understand. Having said that, in our interactions with the wealth managers, and increasingly with the investors, I think they are very receptive to the idea, given the past performance of about 2.5, for now almost 3 years. They have been receptive. They have been putting in extra money, and we are finding some good momentum going on to the fund. Regarding the fund, we've managed well in last 2.5 years with generating returns as per the stated objective, reducing the volatility while producing absolute return over the last 2.5 years. So it has been a good positive experience.
Anything that you would like to share or add to that, Nalin?
I think, Vinayak, one of the things that has been an important part of this journey for all of us is investor education. A lot of people are very, very excited about Category 3 funds, but like with all new investment vehicles, they want to start off with a small allocation and then build as they experience the returns and build more comfort with individual managers' styles. I think one of the things that's unique about this space, relative to mutual funds, relative to PMS, and even relative to the other two categories, is that there is a very, very wide diversity of manager styles in this arena. So even if you look at the three leading managers, which is DSP, Ambit, and us, there is a radically different approach to managing money in these portfolios. So that is why investor education for both advisors, product managers, and end clients has been very important for this journey.
So that's a very relevant thing that you highlighted, Nalin. So I mean, even we experienced. How do you think the distribution mechanism, or the distribution system, is equipped to advise on a strategy like Cat3, where the opacity angle comes a bit, or the black box angle is slightly higher than other asset classes within the same category? And if one were to different strategies, right?
Yeah.
So if one were to select what strategy, or which strategy fits a client's portfolio best, I mean, how should one go about doing the due diligence in terms of suitability of what fund works for him? Is there anything that you would like to share?
So I'll give you an honest answer, since we're among friends. Some people are equipped. Specifically, a lot of traditional push distributors that are just selling on the basis of past returns are probably not equipped for this space, because the approach is a focus on risk-adjusted returns, and holdings may change more frequently. There may be a use of leverage, options, etc., etc. More sophisticated advisors and more sophisticated clients, the large family offices, the large national distributors, I think are in a position to be more well-equipped.
Right.
And they ask tougher questions about process, about positions, a lot more questions on the risk management side. And they, I think, are equipped to really grow this space in partnership with us.
Right. Anything that you would like to share, Martin?
Basically, alternative investments have been looked at as providing negatively correlated solutions to an investor's portfolio. And there was some debate about that in the previous panel discussion also. So the point I would like to make here is a bulk of the negative correlation might be coming from the Cat3 space. So, which is why we stand to be a biggest beneficiary of the whole thing. Let us not lose sight of Cat3 saying that it's a leverage space and it's a high risk thing. It's a pretty sort of defining Cat3 space just by leverage. Most of the funds, I'm sure the other two panelists also will agree, the leverage is being used rather to increase returns, is used for diversification. So like leverage brings in certain amount of risk to the table, concentration and illiquidity also brings in a lot of risk to the table. So when you look at risk, risk should be looked at in tandem with concentration, illiquidity, and leverage.
Right.
So this will give a lot of idea of what kind of risk managers like us are taking and how we have to be evaluated. All these things will go a great deal. As he said, investor education should be done in terms of these three aspects rather than just looking at us as a leveraged entity.
Right. So, just because every strategy is different, there is use of leverage. A lot of things, especially an absolute return strategy or a long short strategy, is relatively new in the Indian investment
Yes.
Atmosphere, right? So, say if one were to look at parameters in terms of fund selection, would there be any thumb rule in terms of what fund works for whom, or if there are 10 different funds on a table and one were to select 1 or 2 funds, and also it comes because the track record is relatively recent. So is there any thumb rule that one can work with in terms of advisor, or even an investor that were to look on their own, considering a fund? What could be that, if there is thumb rule that we could put?
So that's a good question. So basically, in terms of selection of a fund, there would be various criteria. And first, before going to those criteria, I want to make people understand that Category 3 is a very open space, and there would be many different strategies. So there would be no single metric which would be applicable to all the strategies. Now there would be long-only funds, there would be relative return funds, there would be absolute return funds. In future, it may go to commodities, currencies, etc., etc. So there can't be any single matrix. Secondly, what I would also want to say is basically the investments in those kind of portfolios will depend on the investor's risk appetite. Now, for example, a Category 3 AIF, if you compare to any other investment vehicle like a mutual fund or a PMS, if I'm doing the same thing what a PMS or a mutual fund is doing, it doesn't make sense, purely because those are far, far more efficient tax vehicles. So a vehicle which is used to change the risk matrix, and I would call as risk-adjusted return matrix, I think that is something which has to be seen in context. Second, the returns you generate. What is the what kind of risk are you taking for generating those kind of returns is something one has to carefully study. For us, we track standard deviation or volatility extremely closely. So we have been generating returns at about 6% volatility versus an index of about 16, or any other long-only fund which would be about 20, 21. And secondly, Sharpe ratios, which is the proportion of risk you take for the returns you achieve. Higher the Sharpe ratio, better it is. So all these kind of different metrics will come into picture, and I think a constant or a continuous education from our end, from the industry, is going to be extremely useful in determining these kind of things.
Sure. Anything that you would like to add to that, Nalin?
I think one of the things that we spope about prior to the session, Vinayak, is benchmarking.
Right.
How do we benchmark some of these strategies?
Right.
And in our experience of talking to hundreds and hundreds of end clients across India, most people have one of 2 benchmarks in their mind. They either have a very safe liquid fund or fixed deposit kind of benchmark, and then a nifty kind of benchmark in their mind. And that, so that has been communicating how to benchmark some of these strategies.
Right.
Has been part of that investor education.
Right.
So what we have done is we have told people that don't look at us on a month-on-month basis, but over a 2-year period or a 3-year period, regardless of what markets do, we should beat an aggressive cost of capital for you.
Right.
So that is, and there are a lot of people that have appreciated that kind of approach.
Right. Yeah, that's a very interesting option. Anything that you would like to add, Martin?
There is a general feeling that hedge funds, the kind of returns they generate, is because of the higher risk they take. Is it real alpha, or it is because of a higher beta? So there is something called alternate beta just to be looked at.
Yeah.
So that is something we would like to tell you, so that when you question us, how do you question us? So the conventional beta is for the long only style of funds who use only long type of strategies in their investment this thing. But when it comes to hedge funds, we use long short strategies, we use derivatives, we use leverage. So in this scenario, how is that you're going to do it? This is very from a theoretical point of view. But from a very practical point of view, we would like to emphasize the fact that the actual risk that the client undergoes is what has to be taken into consideration. And the actual return the client generates, for example, the CAGR, is what really means, what really brings in an investor, and what pains an investor is the drawdown or the valley that is found between two peaks in an equity curve that really affects an investor at the heart of it. So if you take that, we say that it's very simple to take it from a CAGR to largest drawdown point of view, what is the performance of the fund. This is a very easy and simple way of evaluating a fund. And most of our funds in the Cat 3 space are relying on underlyings which are very liquid. So if you have to take the liquid side of the alternative investment space, I think Cat 3 is the largest space that somebody has to look at. If somebody is taking a call based on liquidity, and Cat 3 guys are the guys who are very liquid, and the open-end schemes are available in Cat 3 only, if I am correct. Right. Cat 1 and Cat 2 are more closed-ended. So there's a lot of case for us to build for us, in spite of a lot of apprehension industry-wise about hedge funds. And if you see worldwide also, we had some statistic numbers being discussed this morning. 27% of the funds are getting into the hedge fund space. And one of the reasons is we are capable of declaring a daily NAV if we are not using anything in the unlisted space. So as a risk management exercise in our fund, we are not getting into any unlisted investments or unlisted derivatives as a matter of risk management. And it gives a level of comfort to a client when we are being open-ended fund that they can exit at their will. So these are some of the facts that have to be taken into consideration while evaluating a Cat 3 fund without losing sight of hedge funds being risky. And it's a misconception. Leverage is not a sin. So it is used for the purpose of diversification, and there are a lot of other benefits which have been taken care by a hedge fund in terms of liquidity and in terms of diversification across multiple asset classes.
Great. So that's a very relevant topic that Madhavan touched, was alternative beta. So there's a lot of debate that is happening globally around alternative beta. So do you foresee that sort of a deconstruction happening in India between alpha, beta, and alternative beta going forward once the industry matures, or like?
See, again, alternate beta is a theoretical aspect that I'm trying to say. Let us not confuse our investors with all these things, but I brought this subject because it should be thrashed out here. So that's why I brought it out. So that alpha, beta are all important aspects, but the real thing that matters to an investor is what I just spoke about. So alternate beta has got its place, so it has got its relevance. It has to be taken into consideration. Our wealth managers, the discussions we are going to have with the wealth managers, and how to fit in these products into the wealth portfolios of their respective clients is a large amount of activity which has to be done. So the wealth managers, you know the portfolio, you know the balance sheets of your clients, and we know the nature of risk that we are taking. We know the kind of players that we are existing in this entire system. So we'll be able to tell you what is the kind of risk we are taking, and you'll be able to figure out what is suitable for your client and what is not suitable to a client. It's as simple as that.
Right. So, and there's another thing that I wanted to bring up was, like, based on my interactions with advisors and also with investors, there is this apprehension that these strategies are only scalable up to a limit. Which somehow I tend to disagree, but it will be great if you can have fund managers' perspective on that, because anyways, we are only looking at in terms of leverage 160 scripts that are available in the market. So probably that's where this apprehension comes from on the Cat 3 side.
Yeah. So again, a good, interesting question. Now, let's understand in perspective is basically while all these strategies are pretty flexible in what you deploy and what you're not deploying. Our fund actually says that about 75 to 80% of the fund would be in the top 160 names, which is the futures segment. And generally, future segment is 3 times more liquid than your cash segment. So on liquidity front, I don't think it is much of a worry. Also, one perspective I will give you is basically, while we were operating this strategy in my previous organization, I used to manage in the same strategy about $500 million without any problems. So I don't think liquidity is much of a problem, under these strategies.
Right, right. Any inputs from?
Yeah, sorry, please.
No, I think it's too early to talk about capacity in any of these strategies. And in fact, I would argue that some of the larger mutual funds are facing capacity issues.
Right.
Some of the prominent flagship funds of leading AMCs are today, almost at 10% of the paid-up capital of certain frontline mid-cap companies, right? So I think the conversation about capacity needs to be held in that forum, not in this.
Right.
And just to add on Nalin's point is basically, if in case I want to get out of my whole portfolio, I'll not take even 2 days. Right, yeah. So that's kind of the liquidity of what we operate in.
That's a very relevant one. Yeah. So, and also another challenge that or the trend that we are yet to see in the Cat 3 side. I mean, have you seen a lot of interest coming from institutional investors? Like globally, one of the biggest investors are the pension and endowment funds, sovereign wealth funds. So have you seen interest coming from the institutional side yet? Or if not, then what could be done about getting the necessary ball rolling?
Well, actually, one thing we have to also understand is basically alternate investment funds have been in space in India for last three and a half years, effectively. I mean, though the guidelines came in 2012, we've seen starting up with these funds more from 2013 onwards. So we are, get to have a larger track record and investor education. Secondly, in the case of the global scene, all these, there is a very interesting trend in terms of the investments. That is, with active versus passives. And you are seeing money either, which is relative to benchmarks, rather going into passives, which are like ETFs and smart beta. Whereas in case of actives, it is funds which can generate alpha or absolute returns. And you are seeing that all the global pension funds or endowment funds, are looking actively towards a space of actives because they want consistent return over a period of time and are not prone to the market movements or relative benchmarks. In case of India, as I said, we've just begun. I think it will take some huge amount of time for investor education and for us to educate the regulators for allowing probably pension funds and other authorities to invest in. Having said that, we are already getting investments from family offices, corporate treasuries, high net worths, ultra high net worths. So the acceptance level is increasing pretty fast.
Right. Yeah, I guess that explains the phenomenal growth in the Cat 3, especially compared to Cat 1, Cat 2, especially since January this year. Right. And so, anything that you would like to add, or otherwise, this is a very exciting asset class to be in. I'm sure our audience would have a lot of questions as well. So, any insights or inputs that you would like to share?
From an institution perspective, there's again this perception that trading is something they should not touch or something like that. This has to be taken to the institutional desk and talked about. So there is a challenge there. But first of all, there is a challenge in terms of talking to the regulator in terms of the trading strategies or short-term, long investments are long-term. That is not the way risk actually manifests in reality. Trading strategies, even though the activity might be short-term, but the visibility of the investment manager or the fund manager is also long-term. It's not that since we are entering in and exiting in a short-term basis, our vision or our outlook is not long-term. We are also long-term players, and we are also here to stay for a long period of time, only for the fact that we are trading from a short-term perspective. And we have got enough data to suggest that the volatility in a particular portfolio can be brought down by increasing the frequency with which you trade. So all this is real facts. But the fact is, this has to be talked about to the institutional investors, and I'm sure it has happened in the US. It'll, if those trends have to come in here, it will follow one time or other. But the fact is, it's going to take some time,
Right.
and we'll have to first lay the foundation for this kind of trading strategy being recognized at par with other strategies, and then I think it will follow suit.
Right. Right. So having said that, another thing that was coming to my mind just now was like, do you see a lot of scope for product innovation within Cat3, given the flexibility that is there in terms of strategies?
Absolutely, and I think
Yeah.
that there are still yet many more managers to come to this space. Right? And in this space, product innovation is a function of what a manager's style is
Right.
and what his individual capabilities are. Right? So I think that there are many more managers to come to this space, and maybe 3 to 5 years from now, we'll be sitting here and we'll be having a panel on, only people that are doing CTA style trading,
Right,
or
yeah.
people that are only doing event driven,
Right, yeah,
or
yeah.
global macro, or
Right.
the way if you went to a global hedge fund conference, you have a lot more subspecialties.
Right. Right.
But so I think there's a lot of scope for that.
Right. And so the final question that probably I'll ask all of you would be, what would be that one hurdle that you feel for the industry? Or, if that is addressed, it will be like, in terms of on the regulatory side, or even like how the funds are positioned, that will take especially the Cat3 side to the next level.
So for us, we think that the biggest hurdle which can be crossed through is clarity, huge amount of clarity on the taxation side. There is too much of confusion in category 3 currently. We are absolutely happy to contribute to the tax authorities, but what we are also saying that, or making the tax authority understand is basically a pass-through structure in category 3 is not evading of tax. It's just that the tax is being treated in the hands of the investor and not at the trust. So if that is, if that happens, then we are good to go. And our growth, you will see, will come in leaps and bounds. Alternatively, we may suggest different arrangements suiting the taxation authority, but we need great amount of clarity on the taxation piece. Secondly, which a longer term hurdle is basically constant investor education and wealth managers education, because as I say, category 3 is a vast category, and there would be numerous strategies under the category 3 funds. So it's going to be difficult to paint everybody with the same brush, and one has to be careful doing that.
Right. Nalin, your thoughts on that?
I think tax is a big thing, and I think that the industry doesn't need equity fund taxation to really rock it. Even debt fund taxation, where if you had a 3-year holding period with indexation, is good enough to be a remarkable game changer.
Right. Interesting.
I would like to divide this into two things. One is the perceptual change that is required. Another is a structural change that is required. If the perception changes, structure change will definitely follow. So the very perception about Cat3, Cat3 is the categorization. So it should not be literally looked at as category 3. So if there is a perceptual change in the eyes of the investor, in the eyes of the intermediaries, and in the eyes of the regulators, then I feel structural changes will follow. It is because of this perceptual aspect, there is some problem in terms of the taxation, in terms of other aspects and all. Like for example, there is a restriction in terms of number of times you can leverage. There are a lot of restrictions for a Cat3 fund because of the perceptual issue. So as early torchbearers, fund managers of this particular category 3, the main job we have got on our hands is to bring in a perceptual change within the industry. So this is going to be a lot of hard work. So the kind of capital that we are going to build in is secondary, but the perceptual change is what has to be primarily done in this industry, and that's what we are all looking at. And with this perceptual change in place, I feel then the taxation issue will get resolved. Then with the now FMC being merged with the SEBI, then at some point in time we'll be able to trade in commodities also. And all these things can bring in a lot of change in the overall industry, and the liquidity or the capitalization issue which we talked about initially, capacity issue which we talked about initially, will also be taken care of.
Right.
So capacity is a function of the liquidity in the market, and as all of us said, that capacity is an issue with Cat 1 funds, Cat 2 funds, or Cat 3 funds.
Right.
So only the issue is different. I mean, the type of issue is different, but the capacity issue is going to be there always.
Right.
And this can be done away with the expansion of markets. And all this can happen with perception change.
Great, great. Thank you so much. Now I think we are good to go for the questions from the audience. So please feel free. Any questions? Someone there?
Yeah, one of the things that I noticed is that these funds are in existence for the last 2-3 years at the most. And from the liquidity perspective, I've seen that some mentions as to that getting out of positions has been relatively easy. Now, we've not experienced any Six Sigma, Eight Sigma events so far. So maybe when we are talking, we are looking at a very liquidity risk being understated. In any of your scenario analysis, that stress testing that you all have done, what is the kind of maximum drawdown that you guys have kind of done analysis on, which would have a large impact on your potential investor base? Because that's the key, right? Because we are looking for a lot more and more investors to participate in this asset class. So could you have someone throw light on that?
Sure. So in case of drawdowns, you are right that in last 3 years there hasn't been event like 2008 which had been there. But what I can tell about the track record which is official and in public domain is basically that in last 2.5 to 3 years, my maximum drawdown on my fund is 0.2%, with 2 months of negative in last 30 months. Okay, so that is the kind of risk management which we do. In terms of the liquidity, one has to understand that these positions are largely into future segment, right? And future segment doesn't attract any circuit filters generally. So in all desperation, if I want to get out, I can easily get out within the said period of time. Thirdly, the drawdowns are a function of what is the regular hedge which you are carrying onto the portfolio. And by hedge, I mean by the opposite side of positions. So for us as a fund, there's a certain minimum percentage of shorts which we generally keep into the fund. Now, what does this do is basically there are two types of risks, in equity markets. One is a market risk and one is just stock-specific risk. A constant hedge generally mitigates huge amount of your market risk. So in a Six Sigma event like 2008, the drawdown would be far, far limited because at every given point in time, you would be hedged by a minimum percentage, which you will always carry into the portfolio. I guess that should answer, that answers questions or not.
No, but one of the aspects of liquidity management is not getting the market price. I mean, if it's a Six Sigma event, your market price is going to be reduced considerably.
Yeah.
So, the aspect of liquidity management is not only the funding side, but also on the asset realization side. And that is where my question is, drawdown would be to what extent, and would that scare away your potential investor? That's a concern. And therefore, from your scenario analysis, what kind of max drawdowns have you? I'm not talking from your current angle, your risk management, because your model probably is not belies what risks could be associated given an extreme event. The tail risks probably are not captured when you're saying just 0.25% drawdown. When you're doing a tail risk capturing, what kind of drawdown are you seeing?
Okay, so for example, for our fund, we are carrying at a VaR of about 1.5% to 2% currently, which has gone to about 3 to 4% of value at risk, on the higher side. Now, let's assume that it's a 20% down circuit for a day or something like a 2008 scenario occurs. If we consider that you have a minimum hedge position, you have a long position, all in all, in case of 2008, which is again not in terms of official record, we did make money on 2008 and didn't lose money. So, we haven't experienced that kind of drawdowns. Our maximum drawdown for last 6 years has been minus 3% for 6 years, not even the fund. Okay, so, and there has been, all those kind of Six Sigma events. So I don't know. Each and every individual strategy would be different. Now, if it's a long strategy with a leverage,
Right.
then the whole drawdown matrix will be different. So for us, it's a continuous hedge strategy. So that's why we have our drawdowns to the minimal.
Got it clarified, sir?
Yeah, I have a question. The size of the Cat 3, Cat 3 industry at this point of time would be in the region of 3,500 crores. Is that correct? Yeah. So what do you think would be the corpus maybe 3 years, 5 years down the line? When you've been meeting investors, you've been meeting, family, offices and so on and so forth. So
I think
but
that
just a ballpark figure.
I think it's quite reasonable to be at about 20 to 25,000 crores at an industry
That's right.
level.
Okay.
And probably that would be spread across maybe 10 to 12 credible managers.
Okay. Thank you. Yeah.
Yeah, and just to add on to that is basically that 25,000 crores can happen quickly if you get good amount of certainty in taxation. So,
Okay. Right.
Yeah, we have a question there.
Steppenwolf Gulmohar. A couple of you probably know me for a while. I've been in this industry for 9 years now. And just following on from the first question, what continually frustrates me in this industry is India long-short managers globally, by serious allocators, they're considered really long-only managers. They don't know how to manage the short side. Most of them have a correlation of 70%. Managers like me, for example, who cast your mind back in 2008, SEBI kicked me out of the market. I lost under 16%, but my investors still pulled. While there were managers out there who lost 40, 50, 60%. They made their money, they discredited the asset class, and unfortunately the asset class hasn't been able to grow. So my question to you again is, and again, a couple of months ago we had a rather silly Bloomberg article, I don't know if you guys read it, talking about how the correlation of India long-short is 70% to the long-only index, which is a bit absurd. Is there a real danger that something like that might happen to the domestic market, where we have long-only managers swamp the category 3 classification, and people turn around and say, hang on a minute, if you've got a 70% correlation to the market and you're going to fall over 15, 20% in a year, or fall as much as the market does, what's the point? Is that danger there? And as an industry and as an association, what do you plan to do about that?
So Vijay, great to see you today. I think among Cat 3 today, there's actually category 3A and 3B, not officially, but in people's minds. 3A are guys like us that are running hedged portfolios, and 3B is people that are running pipe or small cap or very concentrated long only absolute return portfolios. And there's demand for both categories, but I think there's clarity in the minds of investors and in terms of and advisors that the two subcategories are actually different.
Should I rephrase your question a bit? You're asking whether we are very positively correlated with long-only assets?
No, I just want to know in terms of the education process, because my biggest frustration, like take this year for example, when I read that Bloomberg article, my first frustration was to say, this is outrageous. This has been a great year for long-short. Like my long-short managed accounts, for example, are up over 60% gross because I've had multi-bagger longs and shorts which have completely crapped out. Exactly what a long short should do. So why is this negative perception there globally among Indian long short managers, and what do you plan to do against it for the domestic industry?
can I take that? I'll
Yeah.
just say that the problem with hedge fund managers globally is they try to maximize return rather than optimize return. Okay, and that's where something like a risk-adjusted return concept comes in, right?
Yeah.
Now, if I'm bearish, or bullish, or say either of those. I mean, if I'm bullish, say, I would not go 150% of my fund size on the long side, right? And if I'm doing that, I'm doing injustice to what the mandate is about, right? So that's where you will see that the non-existence of discipline of running an absolute strategy and non-correlated strategy goes for a toss when somebody thinks about maximizing the profit and subsequent objectives. For us, I think we are 0.2% or 0.2 times correlated.
Fantastic.
So,
yeah.
that's where we are. I mean, as I said, the whole thesis is basically don't try to maximize profit, try to optimize it.
But I'm just trying to say, look at it in a different way. Come in and run a 60%, 70% net, and have a 70, 80% correlation.
Two things. One, it doesn't necessarily mean that if somebody is running 60% net is positively correlated, or subsequently, I mean, it has be.
Sure, I'm just.
So the correlation can be down even if you are running a 60% or 70%
sure.
hedge. Two, if you are disciplined enough to stick to your mandate, of absolute return, I don't think the other issues come. Three, you should not get carried away by what investors are asking. I mean, we have been asked where the index in a particular month has been up by about 5-6%, and we made about only 1.5-2%. And we have been asked that you guys have not participated, and we are absolutely clear that we are an absolute return fund, and we are not compared to any Sensex or Nifty. So please, I mean, if you are thinking that you are going to get at the benchmark as a Nifty and Sensex, we are not the right place to be in. So if we stick to the mandate and if we are true to our objective, I don't think these are just passing phases. Our bull markets or bear markets are just phases of the markets. I think if you are true to your objective, it will definitely help for the longer term.
Actually, a couple of very valid questions raised by Vijay, and just an observation that I also had. So the growth in Cat3 that has come this year has been especially when the markets have come up from their peaks. So if we have a bullish phase happening over the next 2-3 years, do we see the Cat3 industry growing at the same or a similar rate?
Sure. Again, a very interesting question. Say for example, if it's a bullish phase, definitely your relative products or other products would definitely look far more attractive. But one has to understand, what is the returns you are looking for, right? I mean, whether I am looking for 25%, 30%, 35%, or probably I'm happy with 15 to 20% on a consistent basis. So if you're, again, true to your objective of investing, I think that should solve all your problems.
Sure. True. Fair enough. You want to add to it?
Yeah, please.
I think when you talk to a lot of sophisticated investors, large family offices, who are quasi-institutions in themselves, they're not worried about a bullish phase or a bearish phase or a range-bound market. They're looking at it as a portfolio allocation. Just like people allocate to debt, even in the largest of bull markets,
True.
right?
Yeah.
People continue to run SIPs in the worst of markets, right? It's a portfolio. It's an asset allocation call to this arena. It isn't that they're not comparing it versus a large cap equity mutual fund or even a liquid fund by that measure.
Yes. I guess asset allocation has to be the key when you're looking at anything in the alternative side. Any questions do we have for the panel?
A query in terms of when you look at a hedge fund, you have we are hedging or we are leveraging up to 200% of assets. Say 100 rupees conceptually says your size of a long only portfolio. And let's say you're leveraging up to 200%. What is the weightage you give in terms of what is the right number? Is it 150%? Is it 125%? Is it up to 200%? Is it up to 300%? How should one categorize it? As high risk, medium risk, low risk from a leverage point of view.
What is he asking?
You're
You're asking how are we leveraged at any point in time? That's what you're.
No, what I'm asking is what level of leverage has to be correlated with what level of risk in the portfolio. That's the question.
Yeah. Can I take? Sure. In terms of leverage, from our fund point of view, leverage is not a function of our perception about the market, right? Or the perception about the direction of the market which is going to take. We are basically, that will answer in a sense his question also. When a hedge fund strategist is trying to use long and short in a symmetrical fashion and use leverage very objectively, when I say objectively, those strategies should give in the required input or the required output in terms of what is the kind of capitalization these strategies require. And leverage should not be a function of the perception of the market. That is what we have. But there are a lot of people who are subjective about their proposition, I mean about their capitalization proposition. From our point of view, what we would like to add is being very symmetrical about our approach, both long and short side, and being very objective in terms of capitalization will give you the right perspective of managing risk in terms of leverage.
Can you give an example to help explain the concept better?
For example, we are in the systematic trading space, right? So when you take systematic trading, out of 100 trades, we might be wrong, say 60 trades. Only 40 trades we are right. So that we have a negative strike rate of 60.6. So if our average loss is around 2,000 rupees and the negative strike rate is 0.6, so the risk capital should be around 1,20,000 to capitalize its strategy. So meaning that if all the loss-making trades manifest together, you have the financial stamina to sustain that kind of onslaught. And if you try to, this is about the capitalization side. In terms of being symmetric long-short is the strategy should be in a position to list to what extent we should be short or what extent we should be long. So that will give in a lot of room for managing things very efficiently and to manage things with a lot of conviction. So this is an exercise from a risk management point of view also. Got it?
To add something to
So
it,
basically you are saying it becomes more of a medium risk kind of a strategy than a high risk kind of a strategy.
Absolutely. And SEBI's efforts to regulate leverage have been focused on the gross number. So what you are long and what you are short. So let me give you a very simplistic and crude example. If I was levered 2 times on the Nifty, that's a very, very high risk proposition, right? But if I had 100% long on the Nifty and let's say 100% short against that on the bank Nifty, that's a low risk proposition, right? So when you think about these things, it's the net exposure that really is a driver of risk. And again, in a very, very crude and simplistic terms.
Understood. Thank you.
Great. I guess there are no more questions from the audience. So, great. I guess that's on that note we'll end this session. Thank you so much, everyone.
Thank you guys.
Thank you. Thanks.
Thanks a lot.